Hey traders, Nick Shaheen here. Earnings are coming around. Netflix reports tonight after the close in markets. Also, United Airlines and I believe IBM. So around this time, it's always a good chance for me to make a video on how to use calendars, diagonals, spreads in order to bet on the earnings reaction. So today's video is not so much a recommendation on how to play the earnings, because it's always a coin flip, so your guess is as good as anybody else's, and so go with the gut and maybe try to get some information from the options market to see how everybody else is lined up. Maybe you want to join the fray or bet against everybody. All depends on gut, because the short-term reaction to earnings is a completely binary event. We don't know what the company is going to report, and more importantly, we don't know how they're going to react to it. They being the traders. All right, so into okay, I'm going to use IBM, I think. First of all, I don't like the company. I don't like the CEO. I love the products when they were the PC versus Apple thing, but it's been all talk and not a lot of do. They're still pushing Watson as the thing to do AI this and AI that. And they've been talking about this since I was a teenager. I remember one robot playing against Kasparov or somebody, some other genius chess player. So it's been a while, and if it's going to rain, it would have been cloudy by now. Anyway, I could be wrong, but this is a binary bet, a binary negative bet on the company. For example, if I wanted to short it, I don't want to sell the company. I don't have that much conviction. I don't know it's going to fall tomorrow on earnings. I would rather use puts. Buying put spreads is one cheap way of betting downside. And it's an amount that I would risk that wouldn't break my heart. It's like a lottery ticket, because it is a lottery ticket. The outcome is more chance than actual smart. But there is a smarter way of setting up the bet. So all I have to do is guess the direction. Okay, so let's jump in. So this is the IBM Daily Chart. Every candle is 1 day. We saw last earning it was a jump up, so they must have said something great. Since then, it covered this gap. There's an open gap right here, and it hit this level right here. Now this level is a prior accident scene. So I bet you right here there's going to be resistance. So from here higher, IBM will have to say something incrementally good. And even if they spike, the next line it would fail at is 153. Well, not fail at 154, 155 is going to see resistance. So here it has resistance just based on the chart, ignoring any information that's going to come out overnight. So if you tell me bet on IBM from here for the short term, I'd bet lower than higher without any headline. So tomorrow there is going to be a headline. Let's say it's a bad headline and they're going to give back some of that. There's a big open gap here. Let me go to a year to see how many open gaps it left. I don't. This was one that closed it, so not many. This is an open gap up here. So it's the battle of two open gaps, basically. If you believe it's going to go to 156 plus to close that gap right there, or fall back to here. So it's literally a coin flip. This was an overshoot. That was the December crash where everybody hated stocks. And every stock fell into the abyss of Christmas. So it is likely, so it's an equal chance for this to fill or that to fill. So make your bet accordingly. Whatever I'm going to say now on puts works on calls as well. All right, I'm going to bring in a table. Now this is the options table chain for IBM. Today the stock is up 0.6%. The options are moving. This is this week, next week, and therein lies the story today. I'm going to show you how to play this week versus next week. Okay, so if I wanted to buy puts naked, then I'm going to have to shell out the price of the put. Let's say I'm going to target it falling to 135 or 133. I'm going to have to pay 40 cents for this week to buy the put. But that only has 2 days left on the clock. So if I buy 10 of those, it's $500. And if it falls through it, it's going to turn into a lot of money. But it's only 2 days, and it's so far to fall. And it's got support. So probably not a very smart bet. Why? Because this contract has the most premium based on the event that's going to happen tonight. After tomorrow it opens, that premium disappears. So all these will get cut in half if nothing happens. If price doesn't move, all these will get cut in half. So if I place a big bet, I'm buying too much for it today because tomorrow it's going to be on sale, and I better guess right. So buying out in time is cheaper relatively to normal prices. So if I go out and buy a November put, it'll be more expensive dollars-wise because it has more time, but it probably won't move based on the earnings relatively. So it'll be just as expensive tomorrow as it is today. So I'm not paying a premium for the overnight event. So what do? The best thing to do, if I still want to bet lower, I would buy next week's call and sell this week's against it. So to illustrate that, I could buy next week's, say, 131. Again, arbitrary level where I choose visually. The gap is all the way to 124. Let's say it doesn't go all the way to 124, it stops higher. This costs 45 cents, but I have 10 days versus 2 days. And I can lower my cost, my out-of-pocket cost, by selling this week's against it. Why would I do that? Because this one is a premium, and tomorrow the premium is going to disappear. So I can buy this one for 45 cents and sell next week's against it for 26 cents. So in essence, I cut my entry price in half. I'm going to use round numbers, and I'm still bearish. So ideally, I want IBM to fall to 131 this week and then more next week, because I want this one to expire for 0, and then leaving me long this one next week for cheap, because I only paid 20-some cents for it, because it's 45 minus 25. So this is the idea of this is called a calendar spread. Why? Because I'm playing with the calendar. One this week and one next week. And it's called a calendar spread because they're both the same leg, 131, 131. Okay, that's a calendar spread. This is, some of you are used to seeing a put spread, vertical put spread, which means I don't do calendars. I take 1 week, either this one or that one, and I do a spread here. Like I buy this one and sell that one. Okay, this is called a vertical put spread. Easier to manage, easier to understand. I don't have to deal with timing. I don't have to deal with levels. All I have to want it to fall through my spread, but it's capped. The maximum profit is capped. If I do a calendar, I could have unlimited profits on the way down if I can time it right. Now there's another one called a diagonal, which is just like the calendar, only where I don't choose the same level, not both 131s. So how do I do that? I'm going to use the 132. Or the 133, which you can't see here. So if I buy the 133 put for next week, again, next week, 133 put, which you can't see, I pay 60 cents. It's 57 cents right now. Now that makes me bearish right away, but it's costing me 60 cents, 57 cents right away. So I can lower it, cut it in half, basically, by selling that 131 put against it for this week. So now I have a diagonal. Why is it called a diagonal? Because one is at 131, which is this one, and the other one is at 133. So it's called a diagonal. The calendar would look like this, both 131s. Okay, so that's called a diagonal when I go this way. They're staggered. They're not the same level. The one I'm selling is lower, so my maximum loss is the money I pay up front, which in this case is 57 minus 25 cents. So it's a cheap way to bet, and even if it goes to 0, I still make money here, as opposed to the calendar spread. If it goes to 0, I can't make money because I'm long and short at the same level. Whereas this one, I'm long and short at different levels, where I'm long is higher, so there's some money to be made. The vertical put spread that everybody's used to seeing is like this. I buy, I sell. Diagonal, I buy, I sell. Calendar, I buy, I sell. Does that make sense? Okay, so I'm using this as a scratch pad. All right, so let's erase it and say it again in maybe slightly different terms so we don't confuse everybody. All right, so again, the idea, if I wanted to bet bearish on IBM, I can do it in many ways. One way is to buy a 131 put for 45 cents or 131, 130 debit put spread, I spend eyeball 10 cents, whatever. Maximum I can make is 90 cents, which is $1 minus the money I spend up front. Or I can do it differently and do a calendar where instead of, I'll buy the 131 put, instead of selling the 130 put here, I'll sell the 131 put for this week against my long. So now I have a calendar spread. Also bearish. Or I can do it differently and make a diagonal spread. So instead of doing this one, I'll do the 130 against it. So if I buy the 131 here, sell the 130 of this week, so I'm in a diagonal. So ideally I want IBM to fall through to 130 but not lower, and then let it finish the job next week. Hopefully this is somewhat easy to understand. It works the same way on the calendar, on the call side. Same absolute way. So this has been a quick way, hopefully quick way, of introducing somebody to options completely and using some pretty intricate things to bet on a binary event, which in this case is the earnings. Nick signing out.